Before we dive in, let me promise you something. By the end of this video, you will understand the three major ways people analyze the market: fundamental, technical, and macro, in a way that finally makes sense.
Hey, real quick, before we jump into the video, please take some time to read the full disclaimer on the screen.
If you've ever felt confused, overwhelmed, or torn between these approaches, stay with me, because this script is designed to clear everything up in the simplest and most interesting way possible. And somewhere in the middle, I'm going to ask you a question that might completely change how you look at investing, so be ready for that. Let's begin with something that almost every investor experiences. You scroll through social media, watch a few videos, or talk to a friend who trades. One person says, "Look at the charts. Price action is everything." Another says, "Forget the charts. Look at earnings, revenue, and valuations." And then someone else jumps in with, No. The only thing that matters is the global economy and central banks." So who's right? Which method actually works? And more importantly, which method should you rely on? To answer that, let's break down each method in simple human language, not confusing financial jargon that sounds like someone swallowed a textbook. First, let's talk about fundamental analysis. This is the method used by people who want to understand the business behind the stock. Think of it like buying a house. You don't buy it just by looking at pictures, right? You want to know what kind of neighborhood it's in, how strong the structure is, how old the wiring is, and whether the foundation is solid. That's exactly what fundamental analysts do. They look at revenue growth, profits, balance sheets, management strength, business models, and whether the company is built to survive the long term. For example, if a company makes billions in profit every year, has low debt, and keeps growing, a fundamental investor will say, "That's a strong business. I want to own part of it." But they might not care if the stock goes down tomorrow or next week because they're thinking long term. Now let me ask you something. Do you think you'd be more comfortable investing in something when you deeply understand it? Or do you trust numbers and patterns more than company stories? Leave your answer in the comments. I'm really curious about your mindset. Now, while fundamental analysis focuses on the business, technical analysis focuses on the price. That's right. Technical analysts don't care who the CEO is. They often don't care about revenue, profits, or any of that. They care about what the market is doing, not what the company is saying. They believe that price reflects everything we need to know. Imagine technical analysis, like reading the emotions of the market. When the price goes up, people are optimistic. When it goes down, people are fearful. Technical analysts use charts and patterns to decide what might happen next. They look at trends, support and resistance levels, indicators like RSI or MACD, and try to understand the psychology behind price movements. You may have seen someone say, "This stock is forming a double bottom," or "We are breaking out of resistance." That's technical language. But in simple terms, they are saying, "This is how people are behaving, and here's what they might do next." Here's a question for you. Do you believe human behavior is predictable enough to use charts to forecast market moves? Or do you think the market is too chaotic? Drop your thoughts in the comments. I love seeing different viewpoints. Now let's talk about macro analysis, the third style that often gets less attention, but plays a massive role in how markets actually behave. Macro analysts zoom out to see the big picture. They analyze interest rates, inflation, government policies, central bank decisions, global events, geopolitical tensions, supply chain disruptions, commodity prices, and all the factors that shape the economy as a whole. Think of macro analysis like checking the weather before deciding if it's a good day to go sailing. You might have the best boat in the world, a strong company. You might be a great sailor, a skilled technical trader. But if there's a storm coming, high inflation, rising interest rates, or a recession, it will affect everything. Let's say inflation rises. Macro analysts know central banks will likely raise interest rates. Higher rates often hurt company earnings, which then affects stock prices. That means even the strongest fundamental companies might suffer in the short term. So here's another question. Do you think governments and central banks have too much influence on markets? Or do you think they bring necessary stability? Leave your answer, and I mean this seriously, down in the comments. Now let's compare the three approaches in the real world. Imagine you are trying to understand whether a stock is a good buy. A fundamental analyst will say, check the company's financial health. A technical analyst will say, look at the price trend. A macro analyst will say, see what the global environment looks like. And all three can be right at the same time. The magic happens when you blend them. For example, if a company has strong fundamentals, the global economy is supportive, and the charts are showing an uptrend, that's a powerful combination. But if the fundamentals look good while the macro environment is collapsing, the stock might still fall. Or if the fundamentals are strong but technicals show weakness, you might wait for a better entry point. This is why some of the world's best investors use a mixture of all three. They might rely primarily on one approach, but still respect the others. You rarely see a successful investor who only uses one method and ignores the rest entirely. Now take a moment and think. Which of these three feels the most natural to you? Are you the type who likes understanding businesses deeply? Do you prefer quick decisions based on charts? Or are you someone who wants to understand the global forces shaping markets? Share your style in the comments. Your answer might help someone else discover what works for them. And if you've been enjoying the clarity of this explanation so far, make sure to like this video, subscribe to the channel, and share it with someone who struggles to understand analysis methods. Supporting the channel helps us bring more simple, powerful financial education straight to you. Let's go deeper. One of the biggest mistakes beginners make is thinking that one method is better than the others. As soon as a beginner learns technical analysis, they start thinking charts can predict everything. When they learn about fundamentals, they start saying, technical analysis is meaningless. And when they hear macro analysts talk about central banks, they think everything comes down to government decisions. But the truth is far more balanced. Each method is simply looking at the market from a different angle. Fundamental analysis tells you what to buy. Technical analysis tells you when to buy. Macro analysis tells you what environment you're buying into. If you combine all three, you gain a deeper understanding of the market than most people ever achieve. Let's take a simple example. Imagine you find a company with great financials, strong cash flow, growing revenue, powerful brand reputation. The fundamentals check out. Now you pull up the chart. You notice the stock has been in a downtrend for months. A technical analyst would say, wait, don't jump in yet. Let the trend reverse. And then a macro analyst might add, also remember inflation is rising and interest rates are going up, so the whole market may fall more. By listening to all three, you avoid jumping in too early, and that is how smarter decisions are made. Now here's something interesting. Many long-term investors prefer fundamental analysis because it gives them confidence. Many short-term traders prefer technical analysis because it gives them fast signals. And people who love understanding how the world works tend to enjoy macro analysis. None of these groups are wrong. They simply use what fits their personality. This leads me to another thought-provoking question. If you had to choose just one method to rely on for the next 5 years, which one would you choose and why? Leave your answer in the comments. I'm very curious how you think about this. Before we wrap up, let's talk about how beginners can start combining these methods. Start with macro. Understanding the economy helps you avoid fighting against big forces. Then look at fundamentals to find strong opportunities. Finally, use technicals to get a good entry and exit point. This layered approach can dramatically improve your results because you're not guessing. You're making informed decisions from multiple perspectives. And here's something most people never talk about. Mixing these methods doesn't just improve your investing, it also makes you calmer. Why? Because you're no longer relying on a single method that might fail in certain situations. You have a broader set of tools. You understand what's happening rather than panicking every time the market dips or rallies. Before we end, let me ask you this final question. What is the biggest struggle you face when analyzing the market? Is it understanding financial statements, interpreting charts, keeping up with macro events, or something completely different? Share it in the comments. I read every single one, and your answers help shape future videos. If you found this explanation helpful, make sure you like, subscribe, and share this video with someone who wants to learn investing but feels overwhelmed. The more support we get, the more deep, simple, and powerful content we can bring out for you. Thank you for watching, and I'll see you in the next one.